Focus. Ideate. Innovate. Enable. ICICI ETF and CNBC-TV18 present Smartly Passive, unlocking the world of ETFs.
Hello and welcome to CNBC-TV18 and ICICI ETF presents Smartly Passive, Unlocking the World of ETFs, a series of insightful masterclasses with leading industry experts who will share valuable advice to help viewers better manage their money, invest wisely and achieve your financial goals with passive investment products. The series is focused on ETFs. As you know, an ETF is a basket of assets that mirrors the index like BSE 500 or the Nifty 50 and so on. You can buy and sell your units during market hours just like stocks. In today's episodes, we shine the spotlight on Smart Beta ETFs. They are essentially a type of exchange-traded fund that aims to track an index that is constructed using predefined set of rules or factors. The factors can include a lot of things, including value, momentum, quality, and of course, we'll discuss it in greater detail with our guests as well. Smart Beta strategies blend passive investing benefits with active strategies that seek to enhance returns or reduce risk. Let's understand this type of unique investment in more detail with our guests today. Joining me is Mohit Gang, the co-founder and CEO of Moneyfront, and Harshvardhan Roongta, CEO of Roongta Securities. Gentlemen, always a pleasure speaking to the two of you. We usually discuss different products, different asset classes. Today it's going to be Smart Beta ETFs. So Harshvardhan, let me start with you first up. Smart Beta ETFs, it's gained a lot of popularity. This word is used very often, but let's try and understand what are they exactly. It's also compared with factor-based investments. So can you explain how does it differ from traditional ETFs and what are the contours here?
So well, Sonal, let's just understand the basic ETFs or index funds for that matter. So let's just start with say Nifty 50, which is easy to understand by all investors. So you have a Nifty 50 index fund. What it does is it's got 50 companies and there is certain weightage assigned to it. So probably HDFC Bank would have a 13% on it. Hero MotoCorp will have 0.5%. So there are 50 companies forming a part of the index and they have weightage defined by the exchange as the index has been formed. Now what a smart beta or a factor investing would do. So say there is an example of an equal weight index fund. So now you have a Nifty 50 index fund and you have a Nifty 50 equal weight index fund. So what the equal weight index fund aims to do is that allot 2% to all the 50 companies. So it's an equal weight as the name says it. So they would have 2% allocated towards each of the company which is forming a part of the index. So in this particular case, HDFC Bank, while in the Nifty 50 had a 13% weightage, in the equal weight will have 2% weightage. Hero MotoCorp for that matter had 0.5% allocation in the Nifty 50, here it will have 2%. So now if you look at this combination, so what is being attempted to be done is that the companies which are forming a part of the index remain the same, just the weightages change based on certain parameters. Now if you were supposed to compare, like if I give you two more comparison points in this. So if you take the Nifty 50, the top 3 sectors that form a part of the Nifty 50, financial services, auto and IT, that they constitute combined together is about 60%. In the equal weight, that comes down to 44%. Now, if you look at the returns, the long-term returns, which is say probably a 20-25-year return, the Nifty 50 has given say about a 14% annualized return, whereas now the equal weight has given approximately 16%. So if there is a broad-based market rally, you will see the equal weight doing better than probably a Nifty 50 in individuality. So the idea is the constituents remain the same. The weightages change based on certain factors, which was probably low volatility. It could be a lot of other things, momentum, quality. It could be many other factors.
Okay, so it's very specific to what the factor the asset manager is taking in their place as well. So Mohit, let me come to you. We spoke about a whole host of factors, but how should an investor decide which smart beta factors to include in their portfolio, or should be left with this asset manager and you can just pick up whichever you want?
Look, Sonal, I think first things first, smart beta is nothing but it is a smart attempt to make the dumb index look smarter, right? An index by definition is nothing but a dump of stocks, and you just buy the dump and you believe in the power of averages over a long course of time. That average is good, and perhaps it is very difficult for the active guys to beat the averages on a long course of time. That's the essential theorem when you invest in an index. Now globally what is happening is people are trying to make the index smarter by applying some factors on it, right? So index was a dumb, You're putting a factor of momentum, you're putting a factor of quality, you're putting a factor of low volatility, you're putting in umpteen number of factors to make it little smart, so that out of those 50 stocks, if you're buying a Nifty index, out of those 50 stocks, certain stocks are selected on the basis of momentum. Or perhaps if you're buying a Nifty mid-cap 150, certain stocks are selected on the basis of quality. Now the definition of quality again out here is defined by the index itself, right? So it will be ROE, ROC, profitability growth, PEG ratios, or whatever it is. So there are multiple such attributes and multiple such factors, and a lot of historical data globally, not just in India, because India, it's a very recent phenomena, goes all out to prove that factor-based investing or smart investing has actually outdone both active and passive strategies over a very, very long period of time. If you actually track the performances of few of the larger factors, and few of the larger ones, I mean momentum, quality, low volatility and value. These are few of the bigger ones which are actually massively available in India also, have really outdone the index to a very, very large extent. If you compare it with Nifty 50 or you compare it with Nifty 500, wherever you have applied a factor outlay on the index, it has actually outdone the performance by a huge extent.
Okay, that's interesting. But as you said, in India, it's still picking up. Globally, it's more popular right now. But in that case, Harshvardhan, are there any risks associated with such ETFs versus, say, the traditional ones, and something that investors should keep in mind while they're going ahead and buying into this particular class?
So, Sonal, as we spoke about, so what is factor investing or smart investing, that we've already figured out. The question is, there are several parameters on which this distinction has been made. So, one is, again, of course, low volatility. One is momentum investing. Then there is quality, value, dividend, yield. There are several factors that can be applied. Now, if I am an investor which has and I have an individual profile of mine, so say I would want something which is probably aggressive in the market. Okay, so I pick an index, and in that I take that factor based ETF, which basically takes it's a high beta kind of a factor put in. So it says Nifty, say probably 250, which is a small cap 250, high beta 100 or a momentum 100. So I need to be very careful as to which factor am I applying. If I'm a if I'm an investor who does not have a very aggressive profile, so I would probably go for a low volatility factor put into my index fund. So I need to be very careful as to which factor am I applying to that index. So there is everything available. The high beta, which means it really wants to take aggressive bet, or you want to go on the lower side of the volatility. So in the current scenario where people have concerns about valuations, where they believe that valuations are unrealistic and unsustainable, if you are an investor of that category, you would still want to be in the market, but pick. So suppose you take a mid-cap 150 and you want to take a value or you want to take a quality 50 or a 30. So, so the index would, the product that you will be investing into would be Nifty mid-cap 150,
Correct.
quality 30, quality or a low volatility 30.
Okay.
If you are an aggressive investor, you probably go for momentum 30 for that matter. So it just depends on exactly what you should be doing. In this case now, what investors normally make a mistake is they will look at the past returns. So they say momentum 30 has made more returns than a low volatility 30. So I should go for momentum, wherein they were concerned in their mind for with market valuation. So that is something that an investor will need to be very careful about. The manufacturing side, the fund houses are offering everything that is available. You just need to be very mindful of what you are picking based on your investor profile.
So does it mean, Mohit, coming on this, that it's not as risky as a traditional mutual fund would be? Can we say that very precisely?
Look, to my mind, it's a layer between the active and the passive, right? So it's to a large extent passive, but it is passive with intelligence applied over it. So if you are a believer in passive, then there is no way you would not want to believe in the power of factors being applied over passive and made a little smarter to that extent, right? Now, as Harsh rightly said, you have to be smart enough to figure out what attribute you want to pick and what attribute will work in what kind of market cycle. Look, Sonal, if we go deep down in the concepts of diversification, what do we try and see? We try and diversify across different fund managers at times. Why? Because we want to capture the different styles of investing. We say, okay, Prashant Jain was a value-based investor and that's why we wanted to have a Prashant Jain fund in the portfolio. Or we say we want to go for S. Narain portfolio because he's again more kind of a believer on value. Or perhaps when we go to Access or UTI, we say they're more quality-focused portfolios or DSPs more quality-focused. So what are we essentially trying to do as advisors? We are trying to diversify an investor's assets across different styles of investing or different brains of investing, right? But if you can get that in a passive format, that again out there the brains perhaps might waver depending on market philosophy. Last 2 years have changed the definition of quality for many fund managers. Previously no one touched PSU, now PSU is a part of quality as much as for whatever it is worth, right? So you don't want to go with those kind of definitions. Basically you want index to be smart enough to apply that factor which I want. I want quality as my factor, so that all high quality stocks which are determined basis ROE, ROC, growth or whatever, or I want momentum. Momentum has been a time tested strategy in the market, basically trying to get higher returns, trying to chase that alpha, right? So if you are a believer in momentum strategy, and then you would just want to go ahead and buy that factor based fund which is the momentum fund. Whether you buy that on the mid cap or you buy that on Nifty 200 momentum 30, or you buy it on the small cap, that's a different question altogether. So you will have to adjust as per your risk profile on the market cap in terms of what kind of aggression you want in your portfolios. You will have to buy that factor on the large cap side, on the mid cap side, or on the small cap side. But the point is that if you apply factors, you become extremely smart on the passive side of your investing.
Because it's absolutely devised for you. It's
Absolutely.
as per your risk profile and your the factors that you consider. But in that case, let me come to you, Harshvardhan. Can you provide examples of market conditions where, say, a specific smart beta fund will perform very well or perform poorly? Does that happen?
So yes, so now take for instance the extended bull run that we're experiencing right now. So momentum investing at this point in time will definitely generate a higher return than probably just a index constituted put together. So let me put it like this. So come back to mid cap. Okay. So in the mid cap space, the index has 150 companies. Now I have a choice. If I don't want to go for active fund management, okay, so for the moment I'm just leaving that aside, and I'm talking about only passive investing. Now I have an option that I invest into a mid cap fund. Now mid cap fund would have all 150 companies in it, but there may be some which are in momentum phase, some are in the quality side, some are on the value side, etc. Now, if I have an outlook saying that the markets are looking very bullish from here on, okay, I still see that there are 2 or 3 years of extended bull run from here on, and I want to generate that extra alpha on that momentum side. So I will pick a Nifty mid cap 150, momentum 50. So basically, the portfolio that I will be investing into, I will be investing into those 50 companies out of the 150 index, which has a momentum score basically. Saying that which has a high momentum score. So I am likely to benefit out of that extended bull run much more than probably a traditional mid-cap 150 index would do. On the contrary side, I mean, if I am an investor who's worried about, as I mentioned, worried about the valuations right now, but I don't want to be exiting the market because I don't think we have who would dare to exit a market like this today, despite all of us being very concerned about valuations, but I don't think we would have the courage to exit the market at this time. So what I could do in this case is that I would look for value 30 or a value 50, saying that now I want to pick only those 50 companies out of the 150 which are in a good valuation zone right now. So I am in the market, but I'm taking into something which is not momentum, which is on the other spectrum completely, saying that it's value oriented. So I'm getting something at a lower valuation, and so my margin of safety is higher. In case the markets fall, then I'm not going to fall as much, but if they go up, I'm still invested. So there are these things that the combination would have to be applied to.
And that switch can happen easily as well for an investor, right? You don't have to worry so much about that. It's a very interesting chat and very interesting insights from the two of you, but we have to slip into a quick commercial break. When we come back, we'll discuss with our guests more about smart beta ETFs and the role they play in a diversified investment portfolio. Stay tuned for that.
ICICIETF and CNBC-TV18 present Smartly Passive, Unlocking the World of ETFs. ICICIETF and CNBC-TV18 present Smartly Passive, Unlocking the World of ETFs.
Welcome back. You're still tuned into CNBC-TV18 and ICICIETF presents Smartly Passive, Unlocking the World of ETFs. We have Mohit and Harshvardhan in the studio with us, and we've discussed a lot of things, factor-based investing, what are the factors considered here. But let's discuss it in greater detail. And Mohit, let me come to you. First, what is the role that smart beta ETFs would play in a diversified portfolio, and what is the multi-asset or the multi-factor investing that one can look at here?
Look, as I mentioned earlier in the conversation, that once you are trying to diversify your portfolio across different brains and different styles, people typically end diversifying across asset classes or across market cap. That's the best diversification which we typically see in a portfolio, right? But the great advisors or the great portfolios are always diversified across differing investment styles, so that you get a flavor of everything, right? You would want to capture value in the market and you would want to capture momentum alongside, right? So if you're diversified across 2 or 3 of these styles or factors, right, you would always have a great portfolio running across different kinds of market cycles. Multi-factor is when you combine these 2 or 3 factors together and try and weave them together. Let's say you overlay momentum over quality, which means let's say you have a factor of, or let's say alpha over low volatility, which is a very famous index, right? So you would find Nifty 100 Alpha Low Vol 30 index, which means out of the top 100 stocks of Nifty, you would first apply a filter of alpha, which is the stocks which are generating the highest amount of alpha, and then you find the lower volatility stocks on that, and then filter out the 30 which will have the lowest volatility. So which means stocks which are generating alpha and which have the lowest volatility, a great combination of that. Similarly, on small cap, you have momentum and quality. Now, small cap is such a huge index. You have 250 odd stocks. It's very difficult to filter those stocks on the parameter of quality. Momentum you can still figure out, right? Because most of them are running in this kind of a market cycle. But when you overlay quality, first filter them on the basis of quality, that okay, these are the great 50 names looking very good on quality, and then put a second parameter of momentum on that, that out of quality filter, those who have come out, which ones are showing extreme amount of momentum. So when you do these combinations, the results typically are very, very good. The backtesting data is very good. In India, as I said, the fad is still catching up, but the performance of these, some of these factor-based funds has been terrific. So.
Yeah, that's what you were indicating earlier as well. So Harshvardhan, when we talk about factors, how frequently are the factors in weightages or smart beta ETFs, rebalanced? As you spoke about equal weights, then there is a change in the weightage again. And how big is the impact if it is changed frequently?
So, Sonal, typically the weightages would be rebalanced in a quarter or a half-yearly basis. So that's typically the frequency at which the rebalancing would happen. And rebalancing is important because, see, if you're talking about equal weight for that instance, and all you know that the weightages have changed because of price appreciation or because of dividends, etc. So you would want to make sure that you come back to the original style, which is 2% on each stock. So quarterly or half yearly is essentially the period and the periodicity and under which they keep rebalancing. And just one more point I want to add into understanding the equation, like Mohit has also mentioned about it, that we're looking at filtering the 150 stocks in the mid cap probably with something. So what is important, say whenever a fund manager is creating a portfolio in an active side, there are 2 things that is happening. Okay, one is that the companies which they are investing into, and the second element is how much weightage are they allocating towards each company. That is the only differentiating factor between one scheme to another scheme, right? That is what active fund management is. Now, in this case, where the companies are being, the universe of the companies in which you could invest is being predefined. Okay, now weightages are going to be dependent upon the factors that we're going to put in. How much weightage goes to which company depending on the factor that we're using, right? So that weightage is going to be the differentiating factor. The companies are not changing. The 150 companies on the Nifty 50, the constituents of the portfolio is not going to change. Just that weightage is going to define the extra return that you would possibly get. Now, to match that with your investor profile is the key to creating everything. Now, you question how much does it help in diversification? I think you can just create the entire portfolio of yours with just smart beta funds. So you don't need an active fund if you are going to use your investment style and incorporate it into the scheme that you're buying. So you don't need any active management fund in that case. You can simply get everything that you want. You can have one momentum oriented, factor oriented scheme. You can have another one which is quality. You could have the third one being low volatility. You could just do everything that you want and create a smart beta portfolio for yourself and have the entire portfolio constructed out of this smart beta funds itself.
Okay, that makes sense. So, it was definitely a masterclass. We understood everything that we could about smart beta ETFs. But before I let both of you go, I have to ask you one pro tip for investing in smart beta ETFs. We've discussed it at length, but something that you would like to leave our viewers with. Let me start with you.
Honestly, I think everyone should have a smart beta fund in the portfolio. This is an idea whose time has come. And trust you me, 10 years down the line, chunk of the larger industry AUM will be moving towards smart beta. There is a reason why every single AMC is launching fund after fund in spite of not having sizable AUM, because they know the global trend, they know which way the wind is blowing, right? So if you are a smart investor, you have to build your positions right now, believe in the power of momentum and believe in the power of alpha. To me, those are the two smartest factors around there. And if you don't have your positions out there, you're missing something very big, which is about to hit the markets.
Okay, so it's time to get started then.
Absolutely.
If you have not. And if you are doing it, keep doing it. That's the point. Harshvardhan.
So see, my take is very simple. Smart beta funds give you an opportunity to buy into the index as per your requirements. So I think it can't get better than this. So I have an index. I have a choice to pick momentum, alpha, the low volatility, quality, value, dividend, whatever I want out of the index. So I'm taking a niche out of the index and customizing it to myself. So I think it's a beautiful product, provided you understand how they function. So don't just simply go in, by looking at what returns momentum strategy has given against a value. It doesn't work like that. So it's a good opportunity, but use it very wisely and use it to your advantage. Do not go by herd mentality saying that XYZ factor has worked in the past, will work in the future as well. So this is giving you an opportunity to customize the index for your own self based on your time horizon, risk profile, and your style of investing. So use it smartly. It will most certainly be a valuable input into your portfolio.
Okay, Mohit and Harshvardhan, thank you so much for joining us. Always a pleasure speaking with the two of you. But with that, we'll do one thing. We'll take your leave on this edition. Clearly, the allure of Smart Beta ETFs lies in their ability to provide a more sophisticated approach to passive investing, potentially offering investors a chance to achieve specific investment goals or enhance their portfolio diversification. We'll take your leave now, but there'll be more masterclasses ahead, so stay tuned for that.
ICICI ETF and CNBC-TV18 present Smartly Passive, unlocking the world of ETFs. Focus, ideate, innovate, enable.